You can go ahead with everybody then.
Good morning, folks. Thanks for joining us. Thanks for joining another edition of the Morning Money Conversation with Steph and Drew, where we talk about things money and lifestyle. This morning, our partner here with us is Sean DeFreitas. Sean is an accountant, a CPA who practices accounting both in the who can practice accounting both in the US and Canada. He is the principal of Zayick Consulting, which is a consulting firm. So we're happy here to have Sean, who's going to share with us some insight about planning your financial goals, the importance of tax planning, estate planning, as we create our path to intergenerational wealth. So Sean, can you tell us a bit about yourself? Let the audience know who you are, where the idea of Zayick came from, and then we'll go into the conversation. Thanks a lot, Sean.
Hey, you're very welcome. And thank you, Ray. Thank you, Stefan. Thank you, Andrew, for inviting me. Very happy to be here. My name, again, is Sean DeFreitas. I'm a CPA. I've held a professional accounting designation now for a couple of decades. I am a founder, an entrepreneur. The name actually for Zayick, it just came to me during a sofa surfing session. The name came to me. I sort of think that maybe subliminally I picked up on it because it actually means confident, intelligent, and gentle. So I think in various aspects and guises of my life, I espouse all of those particular virtues. So yeah.
Thank you very much. I like the name, actually, very unique. And the first time I heard it, that's an interesting name for an accounting firm. You know, accounting firms usually have very, very serious sounding names. You know what I mean? SD Financial Services. You know what I mean?
Yeah.
But there's a bit of a sexiness to that name, I guess, if you want to put it that way. So I'm opening the floor up to my colleagues, Stefan and Andrew. I think the audience know who both Steph and Drew are. Stephan is my son. Andrew's my very good friend. We've been doing this conversation for a bit over a year now. We bring you a lot of insightful conversation so we can talk about money, but not in the traditional sense that is boring to most people, but sort of put it into the whole lifestyle stuff. So, today is going to be sort of I don't want to say a mundane conversation, but I mean, tax is not most people's favorite subject, nor is estate planning, but we want to bring a twist to it. And if you see, Sean is dressed up, so he's not got on the traditional navy and white and the tie that most accountants are known for. So we want to make it a bit casual. So let's start off, Sean. I mean, when it comes to tax planning, like what is the process when you deal with clients? How do you navigate that process with clients going through the whole tax planning thing?
So just to back up a little bit, I actually think there's a psyop actually that's out there that's cast an aspersion on the accounting profession to make it, dowdy and fuddy-duddy, and so to keep people disinterested, because the skill sets and the attributes that I've had to develop over the years, innovation, communication, really to be able to look at complex situations and then to be able to come up with and to explain them in a way that is going to be meaningful and understood. So that's some of the attributes that I've had to develop, and I haven't met a kind of an uninteresting accountant, but maybe that's just me, and maybe that's the way I'm wired. But I don't want to digress too much. So one of the things I want to kind of highlight to the audience, firstly, is that there are consequences in not planning. Like there's a saying, proper planning prevents piss poor performance. So there is a saying, and it's been developed, and it's quite true. So if you have a plan, and everybody, to my mind, you should have a plan. People have plans for their goals, they have plans for for business, and similarly, part of that planning process involves tax, because really failing to plan effectively is going to lead to financial and then potentially operational consequences. Where it relates to business, there's going to be operational consequences. So we could really bucket these into kind of like a couple of areas. One being missed opportunities. So a failure to plan means you're going to miss an opportunity. The second, and this is where everybody gets a little kind of tight and nervous around taxes, is the liability. So absolutely, if you don't plan correctly, then there's the potential you're going to walk into a liability that you didn't expect, you weren't prepared for, and it's going to hit you in your pocket invariably. And then where we have a failure to estate plan, then on your demise, and it's guaranteed. We all know that we're only here for a brief moment. We're having these experiences as unique expressions of consciousness, and it's a brief experience, and our loved ones will have to pick up the pieces on our demise. And then if you don't plan properly, then you leave the aftermath on your family, on your loved ones. So then they potentially have a tax burden. They have to tidy up your estate, and then potentially they may need to liquidate assets that you've left behind. If you're fortunate enough to leave behind assets, they may have to be liquidated in order to to tie up the estate. So that's kind of how I enter the conversations.
Question to what you were saying earlier about there's some consequences. Can you elaborate more? What are those consequences in terms of tax planning or estate planning to the audience?
So the missed opportunities, being one of the consequences. So you're not able to utilize tax credits. There are various source deductions that you won't be able to utilize. Perhaps if you put a plan in place, you're able to use, some of the structures out there, RRSPs, TFAs, TFSAs even, holding companies. These are things and vehicles, trusts that could be put in place, could be established, and these particular vehicles you could be utilizing. So, a failure to plan, you're going to leave and miss those particular opportunities. If you own a business and you manage a business, then there are incentives sometimes that the government offer to support expansion. Let's take, for instance, SHRED, the scientific research, is it education? I forget what all of the various letters, but I know, for instance, it's definitely scientific research. So that's a credit whereby if there are processes and activities that your business is engaged in, and these activities that are engaged in demonstrably drive a process forward, are innovative, then you're able to claim, claim expenses back and perhaps get tax credits for wages and salaries, some operational expenses that's been incurred on that particular project, as well as, say, for instance, you decide you're going to take on an additional office space. Well, the rent that's applicable, to that particular initiative can be reclaimed. And you know what? I did mean to caveat this at the start of the conversation, just to say, everyone's situation is unique. So you as an individual, you as a business, all of your situations are unique. I don't want you to, listen to this conversation and then go off and start to implement something and then say, I heard Sean DeFreitas saying X, Y, Z. No, before you do anything, you talk to a CPA. One of the responsibilities that you have, I think, as an adult, as a business owner, is you surround yourself with a team. So as a business owner in your team, you should absolutely have a lawyer, absolutely have an accountant, you have an industry expert, you have perhaps maybe a mentor, but somebody that you can work with and can support you, can bounce ideas off, because you're not going to attain your goals on your own. You need a team around you. And you as a entrepreneur, as a business owner, it's then your responsibility to assign tasks to your team and to hold them accountable, and for them to report back to you on, the items that they're supposed to extinguish. Similarly, as an adult, you should have a lawyer around you. Maybe you've bought a house. You'd have had to engage with a lawyer to do that. You can create a will. I know that there's some of these packages now you can pick up and you can, create a will in 15, 20 minutes. But, and again, you should be working with a CPA, and, you should find an individual, work with an individual who isn't, as soon as you pick up the phone to them, is going to say, that will be, $19.99 or $999 as soon as you pick up the phone. They should engage with you for at least 15 to 30 minutes to really discuss whether they actually can add value to what you're up to. So, and then whether the relationship is going to work between you and them, because you want to work with somebody that you find agreeable, and there's a level of understanding. So just to put that, I should have said that really at the start of the conversation. So in terms of, some of those missed opportunities, and then also I'd mentioned the liabilities, because we've entered a stage now where in 2025, I know there's been a deferral. They've deferred that particular policy, around capital gains, where it was going to go from 50% to them wanting, I think almost 67% of any gain. And I think that's basically robbery. The government are legitimizing robbery, because to say that they're going to take 67% of a gain that you've made is, I can't use the word in public that I really want to use, but it's robbery, it's theft. I'm sorry. I don't know what your politics are. I don't know which party you stand for, but for the government to rock up and take 67% of your gain is robbery. Okay. You can't term it in any other way. And I would like somebody to challenge me on that and to tell me it's not robbery, it's theft. Sorry. But it's been deferred. So there are ways and a structure that you can create to avoid being robbed by the government. Let's just call it what it is, because that's what it is.
What are the safeguards to prevent that for someone, whatever they're an individual or a business owner? What are the safeguards you would suggest for someone to protect themselves from capital gains?
It's dependent upon the asset that you're purchasing and what you're utilizing. So the asset that you've purchased, say for instance, you're going to acquire shares. There's some ingenious ways that you can take take benefit of the gain. But again, it kind of all depends what that gain looks like. But for instance, sometimes you can borrow against the appreciation of your particular asset, and then be able to take money out that way. For instance, you got a house, you purchased it for 100,000. Today it's worth 2 million. You can borrow $1 million against that. You're not going to get taxed on that. But again, everybody, your situation is unique. Okay, I'm just throwing out an idea, an example, but everybody's situation is unique. And then with that $1 million, you can then be creative in what you do and what you utilize.
Sean, I just want to ask you just to pinpoint a little bit more on the planning side and the tax consequences. So specifically in regards to the estate planning and the final tax return. So a lot of the times people understand taxes from just a very high level that they have to pay some. But in your experience, could you share a time where you were involved in processing a final tax return, and what were some of the most crucial things that were missed or that people don't know about what happens on your final tax return?
Yeah. So a live example is where an individual was didn't have the best relationship, say, with their offspring, and they had amassed a number of assets, a number of properties, and there had been a failure on their part to plan, and there were a number of different properties they all weren't in one location, and as a result of some misgivings on their part, in one of the territories, they ended up having to, or that property ended up having to be sold, because the government in that particular territory didn't allow assets to be owned by non-citizens. So, there was a huge missed opportunity there. And then a couple of the other properties, again, one of those had to be liquidated in order to find the necessary funding around the tax bill that was left where they were domiciled.
So you were dealing with the executor at the time?
Yes. Yeah.
All right. What kind of pressure and extra pressure did that put on that executor to have to now go through, not only find out what the value of the property was, understand the tax implications, and then having to sell that property? How long did that delay the estate actually being able to be resolved and the asset distributed?
There was a sizable delay, but when you say pressure for the executor, because the executor was a professional, for them it means additional fees. So
it wasn't a family member?
No.
Okay.
Because this individual, their relationship with their offspring was strained. Yeah, for whatever reason. There's kind of reasons around it, but the relationship was strained. So then, therefore, they had turned all of this over to a professional.
Okay.
So in that instance, yeah, the professionals not exactly, and it does me. I'd be doing a disservice to say that they're rubbing their hands together, but you know, ultimately they're doing the job that they're paid for.
Sean, you mentioned an important point in the conversation we're having with that estate. One of the things is a lot of immigrants who have interjurisdictional properties.
Mm-hmm.
For many of us who are from the Caribbean backgrounds, you've got a Jamaican mother and a Trinidadian father, or that sort of stuff, or a Ghanaian father and a Guyanese mother. And you mentioned another thing too, citizenship when it comes to inheriting properties. Now, I didn't know which jurisdiction you were referring to. When you meet with clients who have parents from the diaspora,
Mm-hmm.
whether they're from the Caribbean or Africa, what is the approach you use to educate them that even though they may not have a lot of assets here in North America, whether it's Canada or the US, do you ask them to go back and see what their family owns, where they came from? So that when they do the estate planning, the final tax returns and the addition of assets, how best to approach that to maintain ownership of those assets?
Yeah, absolutely. It's very much encouraged to, to go and actually see the asset, have a look at the property, and then to understand whether they themselves, and I would encourage them to do that anyway, even regardless of whether it was a stipulation that within that particular, jurisdiction that you had to be a citizen to own property in that particular country. I would encourage you to, take citizenship. If you're fortunate enough to have, Jamaican heritage, Trinidadian heritage. My heritage is St. Lucian, and my dad's from Guyana. And I absolutely have a St. Lucian passport. I've looked into my sister's got Guyanese, St. Lucian, British, and she's actually now living in Jamaica. She's married to a Jamaican, and she lives in Jamaica, and she's got citizenship in all of those entities. And I would encourage us. We should hold multiple passports. Absolutely. It gives you greater freedom and flexibility, and you're not anchored and beholden to any one government, as it were. So yeah, no, definitely encouraged to go and actually, touch, see, feel that particular asset.
So what would be the tip from a tax perspective of people who own properties in different countries if they had one or two tips to take away from this call, what would be your number one or two things from a tax perspective?
Set up a trust. So set up a trust and put those assets into the trust.
Okay. Now, would that be a deemed disposition in those countries putting it into the trust that they would have to pay taxes now?
They would have to research, because again, one answer isn't gonna, one size doesn't fit all. So check it out. But to my mind, in most, if the asset is owned by the trust, then it's the trust that's in control, that owns the asset. And then the beneficiaries, because you'd be a beneficiary of it, you're able to utilize the asset. And then what happens when you have the assets within a trust, whereas somebody will pass, and then you've got to go through these lengthy processes. The very next, you pass away today, and tomorrow morning, you being the beneficiary of the trust, you can go straight in and utilize it, and take control of the asset and to do what needs to be done. I have to wait for lengthy processes or anything else to change hands, because the asset is owned by the trust, and you're a beneficiary of the trust. And then the rules of the trust will be set up in a way to say, you know, on the demise, you know, on Sean's demise, you know, the persons who are naming the trust can go on and conduct particular activities.
So you're referring to a living trust at this point, not a
Mhm.
testament.
Yeah.
Okay.
That's a great tip, Sean. To the audience, if you have any questions, we've got a few people on here with us this morning. Feel free to ask any questions. I mean, Sean has a lot of experience. He does tax planning, both in Canada and the US. So if you've got questions, you know, don't hesitate to be shy to ask the questions. You have an option of coming off your camera and asking the question live, or put in the chat, and we will actually read the question out to Sean. I got a question for you, Sean. When people think of tax planning, they think of wealthy people. You know, the guy who's, you know, driving for Amazon, making, you know, doing his job. You know, he probably thinks, I don't need someone an accountant. I just go to H&R Block, pay $50, get my taxes done. You know, we've always seen tax planning as something for the wealthy. What is your opinion on that? And do you think that everybody should be doing tax planning regardless of their income?
Everybody should be doing it. Everybody, you know, be it the, you know, the person who's, as you mentioned, delivering for Amazon, you know, right up to, you know, the person who's working for Bell Media, whichever, you know, shape or guise, because ultimately it's about putting a plan in place to say, okay, you know, in 5 years' time, this is where I would like to be. Because, you know, there are schemes, and when I say scheme, I don't mean nefariously. So let me maybe use a different word. There are provisions and there are vehicles that the government put in place to encourage, you know, saving. So even if it's, you know, you're saving $10 a week, $10 a month, whatever it may be, there are vehicles that you can put that money into. You know, some of the vehicles, for instance, the education saving plan, the government actually contribute to it as well. So, you know, whilst you're putting money in, the government contribute up to, there's a cap. It could be something like $600 or $700 a year that their cap is. Don't quote me because I'm not fresh on the exact or the attributes of the registered education saving plan. But no, everybody should do it. It's worthwhile. It's you've got nothing to lose other than the, you know, the half hour that you're going to spend speaking to somebody. Other than that, you don't have anything to lose.
Thanks for that, Sean. I have a question. So, in our series, we talk about retirement planning. I think that's a very big topic lately in Canada. And I want to speak on Canada. I'm pretty sure the US too, but here in Canada, you know, everyone wants to age in place. They don't have sufficient funds or savings or even a retirement plan to even begin with. How do you approach those individuals, whether they're in their 50s and 60s, or even before that, to start planning their life ahead and not make irrational decisions or just kind of go with the motion? Because going back to your saying, like I think the anchor word is planning. And for us individually, we always mention that, like you have to plan. So how does you approach those individuals to start planning for their retirement?
Really, to talk about, you know, I like to paint the scenario of, you know, you're, I don't know, 77, and, you know, if they continued with this particular course of action, when they hit 77, what the scenario would look like for them at that particular, you know, date and time. And then, you know, really to give them insight into what the future would look like. And then from there, being able to help them to put a manageable plan in place so that that particular scenario that, you know, that's been painted doesn't actualize.
So just to get some clarity on your view of where taxes sit in the whole financial planning scheme, I focus more on the insurance and saving side, but on the tax side, where do you find that people actually start caring about the taxes that they're paying to the government, or even start to want to save on not overpaying taxes? So where do you find people actually start really paying attention to?
I kind of think you got two types of individual. Well, you know, typically I bump into two types of individual. You've got somebody who's prudent, who, you know, they want to engineer a particular outcome. And again, you know, I don't want to get too hung up on it, but it is theft. It's legalized theft, because the government, you know, if the government wants to generate money, go out and make a product, go out and create a service, and then charge for that service, charge for that product, you know, exist like everybody else does, and, you know, like, you know, keep your hands out of people's pockets. But again, that's a whole other podcast. It's a whole other debate and discussion. And people should do their research, because up until a few hundred years ago, things weren't as bad as they are. But then let me not digress. So you got two types of individual: one who's prudent and proactive, who wants to take action to engineer and create a particular outcome. And you got the other individual who, and I worked with one of those recently. You know, I kind of want to call her out, but I won't. But she got stung. She listened to the advice of a financial planner, and the financial planner gave her advice so the financial planner would win. So the financial planner said, "Hey, yeah, you do this. You take your money out of here, you put it into this, because I'm going to get paid off of this particular product, and I'm going to hit my bonus." They didn't say that bit, of course, but I'm going to hit my bonus. I will win. This is a great product for me. It's going to help you. Yeah, it's going to, you know, you can move your money from one place to the other. But what did that person do? She actualized the gain. And then Mr. CRA rocks up and says, "Hey, I need my cut of that gain." Yeah, you've taken it and you've reinvested the money. That's on you. But I still want my gain. That product doesn't exist anymore. I need my gain. $40,000. Thank you very much. And yeah, she's in tears. Well, of course you're in tears. You consulted nobody. You listened to the financial planner. You know, they told you all about the upside, but you didn't ask the critical question: is there any downside of me doing this? Because if you had asked that question, you'd have been told. And if the financial planner didn't, you know, advise you accordingly, then you can sue the financial planner. But you didn't ask the question, and I'm sure, you know, the financial planner lacks integrity, which is why she walked into that anyway. Yeah, and then when I had the conversation with her to say, well, you know, we've put your taxes together, you know, this is the result of it. You owe Mr. CRA or Miss CRA or the CRA, that organization, you owe them $40,000. So yeah.
Is that a case of client behavior? I mean, you know, we've had that clients for the last 30 years of my business life. And, you know, clients sometimes act on what they want to act on, even with the advice. Now, you know, the one thing I've always told, I get a lot of real estate investor clients over the years. You know, Steph is in the same space. The one thing I always told, I always had a lawyer and an accountant on speed dial. right, in the office. So a client's in
Mhm.
the office and they've got an idea they're throwing around. And I would tell them, "Listen, I'm not an accountant, I'm not an attorney, but I
Mhm.
can get you an opinion at no charge. But I suggest you go sit down with an accountant and have that conversation, or with an attorney and have that conversation." What I've seen over the years that a lot of clients, particularly those of, of simple means,
Mhm.
have a difficult time paying for advice. Do you find the same thing in your arena where, people are reluctant? You go to a lawyer to get tax plan advice, he's going to ask you for a $500 or $1,000 retainer.
Mhm.
You go to an accountant, you can get that first, as you said, 50 minutes or half hour consult for free. But then
Mhm.
beyond that, there's cost involved.
Yep.
Do you find that people are reluctant to pay for that advice? And if they are, how do you deal with it?
Mm-hmm. Yeah, no, I think you've hit the nail on the head, Ray. There is a reluctance because, people and these sayings don't just originate, out of nothing. People tend to be penny wise and pound foolish. So, they think to themselves, well, if I, nickel and dime and not give an individual such as myself, say for instance, I'm going to sit down, I'm going to put a strategy together for you. That strategy, I'm just going to pluck a figure out of the air, and not to say that this is what the charge would be, but say for instance, I'm going to put a strategy to get together for you. It's going to cost you $350. Now, somebody would think about that $350 and think to themselves, ouch, I could go to Sobeys or to, that's my grocery bill. I don't know, maybe for a week now with the way prices are, but they'll think along that viewpoint, like, ouch, 350, I don't really want to pay 350. Whereas if you don't pay the 350, you then end up with that $40,000 tax bill. So the penny wise and the pound foolish. But what I attempt to do and what I attempt to communicate with with those who I come into contact with is to really demonstrate my value add and what my contribution is, what I'm bringing to the table, and then I attempt to really show that from a cost benefit, to say, look, the cost of me is X, but then the benefit that you'll receive, this will more than pay for, my services, and what I'm going to provide will more than pay out and pay for itself in the long run.
That's some great points, Sean. Like circling back to what we were discussing earlier, and I think the audience should be, how would you kind of structure a kind of a criteria for someone looking for a CPA? As we were talking earlier, like there's so much things to vent on,
Mm-hmm.
but I don't think people know what to actually look at to, even find a reputable CPA. So what kind of criteria would you kind of put together? There's maybe 4 points.
Yeah. I think one of the basics is somebody that's going to listen, and secondly, to understand your circumstance, because I've said, I think repeatedly throughout our conversation, everybody's situation is unique, everybody's circumstances is different. So, the advice I'm going to have, or the way I'm going to work with, say for instance, if one of my clients is at a restaurant and a restaurant owner, how I'm going to work with them is going to be very different to, say, how I would work with somebody who's manufacturing noodles, for instance. So somebody so you're going to want to work with a CPA who's going to take time to understand your circumstances. So I think that's someone who's going to listen to you, who's going to understand your circumstances, and then I think the third thing is someone who isn't just going to, it doesn't cost you just to pick up the phone and to have a conversation. Hey, I want to bounce something, an idea off you. Perhaps maybe they may structure their, and I've got a few clients of this nature where I say to them, look, if you retain me under a particular fee, then you can get, and this is more for a business client, you can get an hour with me every month, and you can just, throw whatever at me, as opposed to, every time and forgive me, I just want to use this term just to keep the conversation moving. Just because you have a brain fart, you want to pick up the phone and call me. But my day's not built and structured like that. It's, I have my calendar, and my calendar has, 10 to 11, I'm speaking to X. 11 to 12, I'm going to conduct with Y. 12 to 1, I'm going to work out. 1 to 2, I've got the school run. So my day is structured. And it's structured like that. Pretty much I've got, things in my diary from now until the end of the year. So for you just to randomly call me, and then for me to give you the time and consideration that you deserve, that's kind of not fair on me, and it's not fair on you. You're not going to get the best. So, having that structure to say, okay, I know that on the 8th day of every month, I'm speaking to, I'm going to have a conversation with Andrew at 10 o'clock. I know the 8th day of the month, me and Andrew are talking between 10 and 11, and he can throw everything that he wants at me. So those types of scenarios work.
Real quick question on, obviously not all CPAs are created equal.
Mm-hmm.
So are there different focuses that CPAs will, like if you're looking at an accountant, it's a general term, but are there different areas of focus that people should be aware of to say, you know what, we're not all focused on the same thing. We not all know everything. So what are some of those different areas?
Absolutely. So you are going to find people who, or CPAs who are much more aligned with business, and then those who are much more aligned with individuals. So yeah, that's one of the first things that you want to find out is, does this CPA swim in my waters, or are they too corporate? And any CPA with integrity is, once you pick up the phone, you have a conversation with them, they're going to say, look, we're not going to be the right fit. And I've had those instances where I'm speaking to somebody, what they're up to isn't kind of in the realm of my speciality, and I have no desire to learn and to understand things of that nature. So I'm going to add no value. So I'll be upfront and say, I'm not the person for you. However, I do know X, Y, Z. And if I do, because ultimately, again, you vouching for somebody is you're putting your reputation on the line there too. So no, Andrew, you're correct in that. So understand whether that professional swims in your arena, and whether they're actually going to be able to provide value. And that's where the importance of that 15-30 minute conversation, it's really important that you have that. Does this person, are we singing from the same hymn sheet, and can I actually work with this person, and will this person add value to what I'm up to?
Guys, it's we're at the top of the hour, 11 o'clock. I got I'm in a different time zone, so my apologies. But you've had a lot of content shared from Sean this morning. We didn't get into all that we wanted to talk about. I mean, accounting is a very, very wide subject. One of the things I wanted to touch on was the whole cross-border accounting between people who have dual residency in the US and Canada, or people who actually own property on both sides of the border, and how they how they deal with it. I know Sean has a very tight schedule. He just told us that. So we probably have to have Sean come back and speak a little more in detail about how you manage your assets and income if you're started traversing the U.S.-Canadian border. Maybe you got a large snowboard population in Canada. There are a lot of Caribbean people of Black and Caribbean descent now who are now spending a lot of time in the U.S. and Florida. So we want to make sure that they're doing their tax planning properly, so they don't run into problems with either the IRS or the CRA. Because both of those institutions are relentless in their pursuit to collect from us. But I want to thank Sean. There's a comment here, one comment in the chat. Let me see what that person has to say. Kunya said the same consideration has to be taken when selecting an estate attorney. And yeah, that's correct. When you set in your family's estate, I mean, you've got to make sure that you really do the research and validate the professional that you're working with, know that they're actually are competent in the area. I'm in the Caribbean. I've been doing a lot of work in the Caribbean lately. And what I've discovered, I'm actually going to be very specific. What I've discovered, there are a lot of GPs, general practitioners, who cover a broad cross-section of issues. I'm thinking with lawyers now, but they're not specialists in specific areas. So I can understand that comment from Kunya. But Sean, we want to thank you very much for joining us. Thank you for sharing your insight and knowledge with us. And I'm going to ask you on behalf of Steph and Drew, we invite you back to talk about that whole cross-border tax planning, if you'd be open to having that. But I think that's a real concern for a lot of us. There are a lot of folks who they're buying short-term rentals in parts of Florida, and I don't think they really understand the tax implications of what they're doing. I get calls frequently who want to do stuff like that, and I do tell them, you might want to sit down with your accountant if you have an accountant and have that conversation. So
yeah,
we just
absolutely. Be very, very happy to come back and have that conversation. And yeah, I want to thank you again for inviting me. It's been fun.
Yeah, thanks a lot, Sean. And we've got some thanks from our audience. So on behalf of the audience, I want to also thank you, Sean, and you have yourself a fantastic day. On behalf of the Morning Money Conversation with Steph and Drew.
Thank you, Sean, for your time, and it was
You're welcome.
very valuable.
Thank you
for joining us, Sean. Appreciate
Thank you.